I decided to do something very different for this video. I put up a screener of profitable stocks trading at 52-week lows. I selected 4 random stocks that are trading at 52-week lows. A lot of you are going to be interested in hearing my opinion on those stocks, and this is just a different video. It's going to be a very quick overview over them. I'm going to tell you if the stock is a buy, if it's not a buy, and all these kind of things. If you do enjoy them, you want me to do them more often, let me know down in the comments and I will consider it. Very simple, okay? The first stock that I like is trading at 52-week low, and I reviewed it before. I'm going to talk about it again. This is McDonald's, down 14.5% year to date. It just can't rally. It almost bottomed. Then it tried a little bit. Then it's going back down. McDonald's, for the last earnings report, it wasn't too bad. They pretty much did miss on earnings per share. I mean, we could say it's bad, but it's not really too bad. It's a 2-cent miss. Nothing too big. They did beat on revenue, which was pretty good. But the company is suffering. It's suffering in the Middle East and other places due to something that's happening within a geopolitical space, I should say. A lot of you are familiar with that stuff, and some people don't like what McDonald's did, and they just don't want to eat at McDonald's anymore. And this is one reason. The second reason is in the United States, things have been slowing down. A lot of the restaurants have been suffering a lot, many of them, and McDonald's is now introducing a $5 meal, I mean the value meal, and it's going to last, I believe, 3 months or something like that. It's going to last forever, and it's not really sustainable. But this is just something to push up comp sales, same store sales, and just push up stuff in general. And just people are suffering. I mean, especially in California and stuff, McDonald's is not as cheap as it used to be. So again, this is just a slowdown in the United States and mostly around the world. But if you're a longer term investor, this is the best time to be buying those stocks whenever there's a slowdown. This is why I like McDonald's here. I like retailers. I like a lot of those things because they're just slowing down. Everyone believes we're going to have a recession. This is normally the best time to be buying them. And as the market is forward looking, next year maybe we have the recession, but a lot of the stuff could be priced in, a lot of those companies, and they could rally into a recession. It happened many, many times. But for McDonald's, I talked about this in my analysis. The company has been declining in revenues from 2013 to 2020. After 2020, this has been a pivotal point for McDonald's stock, McDonald's company, and they started to grow revenues again. And they've been growing since then. They grew in 2024. They're going to grow again next year, the year after. This is what expected, up to $34 billion by 2028. I mean, this is not bad. If you look at the multiple of the company, it's trading at 20 times earnings. Now, the lowest it has traded at over the last 10 years, even in the crash of March 2020. The lowest it went to was 16 times. And now it's trading at 20 times, 20.5 times. I mean, this is pretty good. This is a pretty good level on a historical basis. If you look at it, you look at this line, this has historically been a good time to be buying a position in McDonald's, which is why, I mean, I like McDonald's here. I can't say the stock is not a buy. I think 20 times earnings is pretty fair for a company like McDonald's with 33% net income margins, high return on capital, and earnings per share, they're still growing. I talked about them using that to do buybacks. This is something they're doing. They just use that to do some buybacks. Not very often, but they do it sometimes. But in terms of earnings per share growth, they're going to grow around 2% for 2024. Again, if you look past it, they will likely grow around 8% again on average, and they expect up to 14%. I'm not counting on it, but you're getting an 8.5%, EPS growth. You have a 2.5% dividend. This is like an 11% annual return on McDonald's, and you could also have the option of a multiple expansion if the stock goes from 20 times back to 23 times. So in total, that could be around 13-14% a year on McDonald's. This is not the highest return ever, but for a quality company like McDonald's, it's not easy to find. I mean, I looked at McDonald's many times over the years, and I just couldn't see more than 8% annual return. But now I'm seeing on the low end 11% annual return, on the high end 13-14%. So for me, if I had cash and I was a dividend investor or a conservative investor, and I like McDonald's here, I think McDonald's is a buy. And I don't think it will keep going lower. If it does, I might consider it myself. Maybe. I mean, I don't mind if I get my 15%. This is my target. I would buy McDonald's, maybe 230, 235. But even here, I think McDonald's stock is a buy. The second stock that's trading at 52-week lows, those are 2 stocks I talked about, but then the other 2, I've never mentioned them. But some of you asked me about them, and they're growth stocks and value stocks. It's very different things. But this one is Paycom. Paycom also came up on the screener. It's trading at 52-week lows. It's down 28% on the year. Over the last 5 years, the stock is down 31%. This used to be an amazing company. But even now, I believe software in general is a good area to look into. Even Adobe, I said Adobe is overvalued, but you have a lot of bad sentiment around these stocks. Adobe and MongoDB and DDog and all the software and the cloud stocks, anything fancy around software except cybersecurity is just crashing right now. After these stocks have been hot for too long, I'm starting to see bad sentiment, and this is what I look for stocks. I look for bad sentiment. I'm seeing it with a lot of those stocks, and especially Paycom, even ADT and many others. But Paycom down 31% over the last 5 years, and even though the company is down so much, it's still actually growing in revenues. It's not declining. The company is still growing 11% compared to the prior year. The company still has 98.4% of the revenue recurring. Pretty amazing stuff. The company still has zero debt. They have a good balance sheet and they have no debt. And this company is still growing and it's expected to keep growing. But the growth wasn't as it used to be. And I believe the stock got punished more than it should by the market. It used to grow 30%, went to 23%, now 10%, and I expect it to be around 10, 11, maybe 12% on the maximum over the next 5 years. So this is not a company in decline. If you look at this chart, you will say, man, this is Walgreens. This is like a dying company. It's still growing 10%. It has no debt and it has all these things. And the stock is trading at 18 times earnings. This is non-GAAP. If you use GAAP earnings, it's around 20 times. 20 times earnings is still not expensive for a business that's growing 10% with 98% recurring revenue. And it has a good balance sheet. It has a lot of things going for it. I think 20 times earnings is very fair for Paycom. And if you more do the things that I do, which is I play on sentiment, I buy stocks with bad sentiment, sentiment changes to the upside, then I sell the stock on the upside. If you do that stuff, Paycom is an amazing stock. If you're a long-term investor, maybe you could get maybe 30, 40% annual return with Paycom. But for me, what I tend to do, I look for bad sentiment stocks. People don't want them anymore. I buy it at a good value. Then the sentiment changes, the stock goes up. And this is when I sell and move on. And I think Paycom is a perfect stock to do that on. And I think Paycom is a buy in general. I mean, I don't see the stock being overvalued. And I really like it over here, especially with how everyone is just trashing the software stocks. This is the best time to be bullish on them. Okay, the third stock that I'm going to talk about, some of you asked me about it. It's a popular one. Cassie Wood bought it. And this is PASS, UiPath or something like that. It's sitting at $12 per share, down 49% year to date. I mean, this is really bad on the stock. Absolutely insane. I think Cassie Wood bought it around 20 and it went to 12. This is what a lot of people told me. I don't really know. But the stock, I mean, I have to say, if you look at the multiple, it's trading at 34 times earnings. You would say, 34 times earnings is cheap. This is a company that's in robotics and AI and automation, is going to do this, change the future and all these things. 34 times earnings doesn't seem too expensive at all. But if you look at a few things, and mainly if you look at stock-based compensation, it's absolutely insane for the company, especially if you look at 2024, which is the expectation on the analyst. If you look at 2023, it's even worse. Cash from operations is negative $9 million. Stock-based compensation is $369 million. I mean, this is a disaster. This is just garbage. Even in 2024, cash from operations $299, stock-based compensation is $371. I mean, it's more than 100% of the free cash flow. I mean, this is crazy. I would never invest in these stocks ever. I think it's a bad mistake to invest in them, big mistake to do that stuff. And I try to avoid them as much as possible. I don't have to look deep in the company. It looks extremely speculative to me. And if I speculate on small micro caps that are actually profitable, like profitable on a GAAP basis, positive free cash flow, not like this company. And even though you're paying 34 times adjusted numbers, which is full of stock-based compensation, the company is barely growing 8%. This is what they guided, 8% and 10%. 8 to 10% for 34 times earnings with such horrible metrics, to me, is not a buy at all. It doesn't mean it can't get a short squeeze and go up. I know it has decent short interest, but I would be touching it here. Maybe around $6, $7 per share. Maybe PASS would look good. I mean, as a speculative position. But to me, it looks absolutely terrible, and I would avoid it as much as possible. This is my opinion. Okay. The last stock I'm going to talk about, some of you know it because Warren Buffett used to own it. I'm not sure. Maybe he still has a position. But I remember it was hot on YouTube a few years ago whenever Buffett bought a position. And this is DEO stock. DEO is down 22% over the last 5 years. crazy. Maybe you're not familiar with the name of the company, but you're likely familiar with the products. They have many popular alcoholic products like, Black Label, Johnny Walker, Guinness, and many different things. A lot of you are gonna know that stuff. I'm sure you're gonna know at least one, Captain Morgan, and so many others. So they have a lot of popular brands, vodka, whiskey, and other things. And yeah, I mean, it's a popular company. It has popular brands, and it's pretty good, but it's been struggling, down 22%. And they've been suffering a demand slowdown. The long-term fundamentals of this industry, I don't think they're actually the best. Maybe alcohol is still growing in some places, but you have so many alternatives right now, and the younger generation, they like other things too. So I mean, I would expect it to go down over the very long term. But in terms of North America, organic sales declined 1.5%. Latin America and the Caribbean declined 23.5%. I mean, that was really, really bad. In Europe and Africa and Asia, it's still growing, but Latin America and North America, it's been really, really bad. And I mean, it's really bad, and it's really hurting the company. But if you look at the multiple, you should hit at 19 times earnings. Now it's trading at 16.8, so it's not the biggest bargain in the world. The stock was overpriced around 26 times earnings, like a software company. Now it's trading at 16.8 times, which in my opinion, on the surface, it looks like fair value, but it doesn't look extremely undervalued. But this is a company that's trading at this multiple, and it's not growing much in revenues. It's going to decline 6.7% this year, expected to grow 3 to 5%, over the next few years. This is very low growth for a company that's trading at 17 times. We just talked about Paycom, a software company growing 10%, trading at 20 times GAAP or 18 times non-GAAP. I mean, DO on the comparison, it looks really overvalued. And they do have a good free cash flow yield. It's like 4.3%. So 4.3% free cash flow yield, if they can grow 5%, that's maybe 9-10% annual return. To me, DO is still overvalued. It's a good company. It has very popular, amazing brands, but it's still overvalued. Maybe around $110, $115 would look a little bit better. But right now, I think DO is not a buy. I think PASS is, I don't want to cross the pass of PASS. I think it's really bad. I don't want to touch the stock. And as we speculate on stocks like SoFi or HIMS or Palantir or other speculative stocks, but this one, I'm not touching it. Paycom, I think, is a buy, and McDonald's, I like it too. And this is just my overview of 4 random stocks trading at 52-week lows. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.